right, folks. So with that, we come to our final talk. I was really looking forward to hosting Brother Mustafa Ladha. He comes from a very accomplished family. They, been many years in real estate development. Multifamily is, their specialty. So this is going to be a fireside chat with Brother Mustafa Ladha. He went to his education was in New Jersey. He's based, in the New York, New Jersey area. He's a vice president at Veloci Capital. Veloci in Italian means rapid or fast. I put a note in the comments earlier where I mentioned that yeah, his family has deployed well over $1 billion for real estate projects, etc. So today in this fireside conversation, we'll talk about multifamily real estate, the halal side of it or the riba-free side of it, some of the successes that Mustafa has had, and what are some of his recommendations. So without further ado, let's bring up Mustafa Ladha. Brother Mustafa, are you on?
Yeah, I'm here. Assalamu alaikum,
Okay.
Tanvir. How are you doing?
I'm doing great. How are you doing?
Doing well. Thanks for
Yeah,
inviting
let
me.
me just pin you while we do that. And um, I think we'll get going. We're going to spend next 25 minutes having this conversation. If it'll help if you tell the audience a little bit about, who you are, your family, a little bit about your family, and then what prompted you to pursue the family business. Your second generation, tremendous success under your belt, alhamdulillah. You're very highly spoken of in the JM community. Many of my friends in the East Coast speak very highly about the work you're doing. So, yeah, over to you, bud.
Sure, sure. So first of all, thank you again. Just like they mentioned in the crypto talk, just want to go over some disclaimers. Everything we're talking about today is just purely educational, especially in terms of the investment side. In terms of the halal, not halal side, I'm not an imam. I'm not a religious scholar. I haven't studied that. So, it's one of those things that we all need to do our own due diligence, need to look into it, understand our own fiqh, our own madhab, and then, decide not to invest or to invest accordingly. Um, Now with that, I want to kind of transition to your questions in terms of my background. I'm of Indian, Tanzanian background with a little bit of Pakistani mixed in there. Like you mentioned, born and raised in New Jersey, grew up in an entrepreneurial family. Originally, our family did, business in Tanzania, business in India, business in the US, in London. So a lot of, strong entrepreneurial, conversations growing up, etc. In terms of our community and we've always tried to give back to the best of our ability. And that's really something that's stuck with me when I was growing up and ultimately led me to pursue and join the family business. At that time, it was kind of more, managing our own capital and friends and family. And really what I've looked to do is kind of bring down the barrier of entry because sometimes with these, real estate investments or with cryptocurrency or any of these types of investments, sometimes, the challenge is access to information and access to actually high quality investment opportunities. So that's really what I've spent a lot of my career working on and structuring so that it can be not only accessible, but in line with people's faith.
Wonderful. Appreciate that. Now, since the topic is around halal investing, actually two-part question, right? So tell us a little bit more about, what specifically you do in multifamily, real estate, like, maybe some examples of, some projects you do, and then how do you structure your deals to be halal?
Sure, sure. So yeah, in the multifamily space, a lot of what we do is ground up construction. There is, a value add side element, especially, where the market is right now. But fundamentally, a lot of what we do is ground up construction. So, about several years ago, I joined that community you mentioned, that WhatsApp community, JM. And I noticed that there was a lot of different investment opportunities that, people were pursuing. So I kind of, took some notes, kind of understood what people were investing in, and then took it back to what we were doing and said, okay, our barriers to enter are quite high. So how do we, scale that down? How do we create a fund structure? How do we make it legally compliant? How do we make it, Sharia compliant for the most conservative investor? So that's really what I focused on. And ultimately, I think in a lot of situations, the easiest way to do it is just structure so that things are on an all cash basis. That way there's, no exposure to leverage. And then, you're sidestepping or avoiding that conversation of riba. Is riba translated as interest? Is it translated as usury? Different people's madhabs are different. And, there's over 1 billion Muslims, right? So people are going to have differences of opinion. And my job is to kind of empower people with the information, and then ultimately let them decide if it fits their buy box.
Great. Now we are about to start 2024, right? What is your outlook, for the retail investor in an asset class like multifamily?
Yeah, I think 2024 is going to be exciting. With an asset like multifamily, it's hard to give a blanket state answer, in my opinion, just because real estate is so niche specific. The market in California, the market in New York, probably more similar to each other than they are to like the market in Nebraska or the market in Oregon or Las Vegas, which is maybe closer to, Cali. So I think with real estate specifically, it's very important to understand the market you're investing in. It's not to necessarily say or paint the whole market in the same brush. So what we invest in is multifamily. And the important thing there is, we've seen a lot of strong growth the last 3 years in multifamily and single family. In office space, it's been a bit of a bloodbath, right? It's been a different situation. So for us, fundamentally, there's a nationwide housing crisis, which is a good thing. Like it's bad, obviously, but it's a good thing in terms of values, right? So there's a lot of demand for the product that we're bringing to the market because there aren't fundamentally enough houses, right? So if there's not enough houses, then current houses, the prices are more expensive, which prices people out of buying single family houses. That means that they need to rent, which is why you see strong demand in multifamily, especially like markets like California and New Jersey, New York. So, New Jersey, New York was really where we invest. Those are, typically stronger markets in the country versus, those markets that, during COVID really benefited from work from home and remote life. So it's kind of important to understand, the market you're in and the strategy. And then for us, in the East Coast, New Jersey, New York area, employment numbers are very strong. Income is very strong. There's strong population growth in our market. Um, and then there's also tax benefits. We invest a lot in opportunity zones. So that's a massive benefit to, our net operating income, how much, cash flow the asset produces. And ultimately that's reflected in how the assets appraise, what they're worth, their value.
When now from past discussions, I learned that if on one hand you have the high net worth individuals who invest with you. On the other hand, you also open up some opportunities for folks in the JM community. And JM is a bunch of Muslims professionals, very collaborative WhatsApp groups, always advising each other on stuff, or helping raise capital for real estate deals. It's a very collaborative group. I love the model, what they do there, just for folks who are not familiar with JM, right? So Mustafa, when you raise capital, is it purely for one project, or put that in multiple projects, right?
Yeah, so for the purposes of the Halal Money Show, for the purposes of Sharia compliant investing, we have a fund that's specifically structured for that. And the way the fund works is it raises capital, right? We have like Fund One, which manages about 7 million. Fund Two manages around 3 million. So it's not necessarily the largest fund structure. It's about 10 million cumulative. But what that focuses on is it raises capital and then it deploys it on a deal by deal basis, right? So that way, investors who are investing for a 2-year minimum, they get exposure to multiple assets. So it increases their diversification. And in the cryptocurrency conversation, they mentioned it a little bit when they talked about diversification and how that reduces risk. So, that's the goal in that fund. And this is not, advertising that anyone should invest or shouldn't invest in the fund. It's just educational on how the fund is structured. And ultimately, the goal there is to structure a vehicle that's in line with people's faith, that's in a asset class that has the potential to generate high returns, and that's structured with a low minimum. That way, people can get started if they want, whether that's with retirement funds or non-retirement funds. And I don't know if I mentioned it, but the minimum there is 25K.
Yeah, no, I'm glad you clarified that, right? Now, and just to clarify also, right? Now I have many friends. big on like investing in equities, right? Because here in Silicon Valley, they're always excited about Tesla and Nvidia and all of that, right?
Yeah.
The maybe not so much in real estate, right? So just for
Uh-huh.
the benefit of the folks who little thing, the single family, which is like, and a lot of people do single family, low barrier to entry.
Yeah.
You buy a house, you manage it yourself, or you give it to a real estate guy who'll manage it for you. And
Yes.
multifamily is typically larger apartment rental complexes that may be 50, 100, 200 units, right? It could be anything more than four or five is multifamily. And then and now from what I get it is your focus is primarily New York and New Jersey, and is that going to be for the immediate future as well, or are you looking to other markets as well?
Good question. So yeah, our focus is in New Jersey. We have invested in the past in Baltimore, and we have invested in the past in Atlanta, Georgia. This year we'll probably be deploying a decent amount in Baltimore as well. So we do see that as opportunistic, and that's a lot of what we invest in is opportunistic investments. That being said, I know you alluded to equities. I think, Tesla, big fan of it. I own stock for years. But I think one of the things is volatility in the stock market is very different than volatility in real estate. Typically, real estate is referred to as as the asset class that's created the most millionaires in American history. So the goal there is to create wealth long term. It's not really get rich quick. The last 3 years or so, you've seen massive rent growth and massive asset appreciation in real estate. That's kind of created this hype that everyone should get into real estate. But the reality is typically the mindset of a real estate investor is long term. While everyone in real estate loves double-digit returns, that's typically not the goal. Typically, the goal is to buy well in a good area that's appreciating and benefit from that appreciation. Now, in the fund structure, we drive value creation, right? So we'll buy a single family house, rezone, which already adds a lot of value, build an apartment complex and sell, right? So there we're creating a lot of value and then we're exiting. So to answer your question, Tanvir, very simply, it can get, a bit like there can be a lot of layers with single family versus multifamily. Single family, typically, the hold times are shorter. Typically, you're buying it and flipping it, or you're buying and renting out. Multifamily, typically, the barriers to enter are higher. And that's why what we've looked to do is create more of a crowdfunding type model where you're saying, hey, you don't need to do all the work. You can come in as a partner. You own the asset by virtue of owning the company that is investing in these assets. So it's an asset-backed investment. There's a lot of layers of protection, and there's a lot of ways that we're adding value. That way, ultimately, it's mitigating risk for you as the investor. Does that help answer the question, Tanvir?
Yeah, yes, you did. I also, for the benefit, I have many of my friends who are on this call today, right? Quite often the natural tendency, Mustafa, is, hey, let me buy it and manage it myself, etc. Right? And speaking from experience, what happens is after some time, the fatigue kicks in, right? Especially if it's a long distance property, the tenant issues, right? And maybe in the middle of the night, you sometimes get called if there's a plumbing issue or whatever, right? And yeah, so to my friends and others, who'll watch this or now live or in the future, looking at someone else doing it, if they're reputed, etc., it takes a lot of that burden off you, right? And then it's genuinely, they say real estate is passive. It's not really passive when you're managing it yourself, right? So that's where an entity like Veloci and Mustafa, they can they we will. I'm not sure if you're comfortable talking returns or whatnot, but if you're looking at double-digit returns, right, and let them do
Uh-huh.
all the work for you, right? Um, uh, so what is the timeline, Mustafa? Are we talking, parking the money for a couple of years, 3 years, or what's the time horizon?
Great question. So I think first I wanted to allude to something you mentioned about like, our mentality with respect to real estate and why not do it ourselves. It's a very normal mentality. I think especially maybe in my community in that Tanzanian, Indian, African like entrepreneurial type background. A lot of the mentality is why would I trust someone else to manage my money? I can manage it better. And that's fine. I think that that's a fine mentality and then go do it and come back to me in 5 years or come back to anyone in 5 years and see, and compare the performance. Because what ends up happening is it's a normal mentality to say, hey, I don't necessarily want to trust somebody else with my capital. I can do it better. And it's possible that you can. But that hasn't been like the data I've seen because I manage, a lot of people's different portfolios. And then it comes down to fundamentally for you as an investor or me as an individual investor, do I have the resources to manage issues efficiently? Like if I have that W-2 or if I have that job that I'm working for somebody and I'm making my six-figure income and alhamdulillah, I'm in a good position where I have money to deploy into real estate, that's a great position to be in. Now you deploy into one asset, two assets, five assets, 20 assets. You have to manage 20 assets now, or you hire a managing company and you have to micromanage the managing company. You have to still perform in your W-2 job because that's, where you're making your money. And then in theory, you have to also be there for your family and your community. And there's a lot of different responsibilities, host the money show. There's a lot of things going on in life, right? So it kind of, to me, becomes about scaling. At a certain point, alhamdulillah, we have the resources to take care of our immediate needs. And then it becomes, how can I efficiently scale? If, in the previous talk, we were hearing from, two experts in cryptocurrency. Great. I'm in a situation where like, I had money on different exchanges and the exchange got hacked. And I'm just like, okay, life goes on. Because for me, it was like a diversification thing. And I'm okay to write off that loss. But at the same time, anytime somebody messages in JM about, Bitcoin and how I should be buying every day, eventually I'm like, okay, fine, I'll buy every day. But I don't necessarily want to move it to cold storage because it's just not worth the effort of learning how to do it. So I'd rather outsource that decision to someone else. And I think the same can be said of real estate where some people want to get started, they don't necessarily know how to. And that's where someone like me comes in, not necessarily me, anyone like me, who runs a private real estate firm. And it's important to some degree to work with somebody who has that, track record and who comes with like strong references, etc. Because then you're mitigating your risk. And that's really important. Like I've been in different communities where people are, raising capital, etc., but it's not done in like the right format. And then ultimately the investment doesn't perform well. And then people say, I'm never going to invest in this asset class because of that bad experience. And it's unfortunate, but it's like we have to do the due diligence ahead of time to make sure that the strategy and the person operating it can perform for me. And then everything kind of scales from there. And in terms of performance, like I don't feel comfortable necessarily disclosing performance just because I kind of want to be careful about like SEC compliance. But in terms of, broad strokes, I was speaking to a friend of mine earlier today or over the last couple of days, and he's, buying assets, single family assets in Illinois, and he's making, let's say, 13% cash on cash return a year, which is, not bad, right? And he owns five assets. So to me, that's great. He's buying them, he's making money. Awesome. When I look at it, I see the opportunity cost is huge because our funds have historically made more than that. But ultimately, it's about understanding that, each prospective client, their goals are different, right? For him, he wants to do it. When he's at 500 units or 500 assets, maybe he'll hire a whole property management team and he'll create it as his business that he's going to switch from a W-2 to running real estate full time. And that's why, investing passively isn't right for everyone. It's just about understanding, your portfolio and how you want to scale and then building out that strategy. And that's where I come in and I say, hey, what are your goals? Help me understand your goals. And then if I'm the right fit for you, awesome. And if I'm not the right fit for you, awesome. Let me know how I can help you. And then that's how, the relationships scale.
Super. Now, what advice would you give? Let's talk about this kind of a persona, right? Young couple, both work in tech, couple of kids. They've got their 401k, they have their stocks, everything. Now they're thinking real estate as long term, like retirement income, etc. Right? What
Uh-huh.
advice would you give? That profile, right? That hey, I want to save up my retirement. I'm now looking at real estate, right? Should they sit down with you, attend, like, do you want to do it as a group or you want to sit them one on one and then, do some goal setting with them? Or how do you engage normally with that profile, right?
So typically that profile person would come to me through a referral. Typically their friend has been making double digit returns for 1 to, let's say, 6 years. So they've already, 100%, they've doubled their money in that time period. If it's been 4 or 5 years, they've doubled their money. So typically that person's coming to me from that perspective and they're saying, hey, listen, I want to get started. I say, okay, no problem. Let's slow down and kind of understand where you are and how I can help. With respect to like retirement planning, which is also kind of what you sprinkled in there, then it comes down to, hey, what do you want your retirement to look like? At that point in time, typically we're looking for like cash flow, right? So I have guys, for example, who deploy, let's say, 1 million with us, and maybe each year they're making 100K a year or 200K a year, depending on performance, and everything's hypothetical, right? Because, I don't want to talk about performance per se. So if they're making that, 100 to 200K a year, in most markets, they have the cash flow they need. They have annual liquidity because the fund gives annual liquidity. And then if they want to exit, they let us know, and it takes about 3 months for them to exit their, principal. So typically, for a couple like that, we kind of work backwards, and they'll say, hey, I'm in California, so 100 to 200K is not good enough. I need 400K. Okay, no problem. And I'm in a 50% tax bracket. So let's just make it 450 to be a bit conservative, and then we'll kind of build it out from there. But also, it's kind of important to understand that because they also have equities in their portfolio, they might not necessarily need to go all in on real estate. It becomes a blended strategy, and then that's how we take it, Tanvir, where we say, okay, hey, how much do you want to deploy to real estate? How much do you want to make in retirement? How are you looking to finance your retirement? Do you want to invest with retirement money? Do you want to invest with HSA money? How do you want, your total portfolio to look? And then we'll kind of customize it and build it around your goals. Does that make sense?
No, it did. Okay. Another profile, right? Good friend of mine said, Tanvir, I'm heavily vested in my employer stock, right? And that stock is gangbusters, man, right?
Yeah.
And what do I do, right? I'm fully vested. Stock is kicking butt, man, right? What advice would you give, someone like that, right? And this is a little older profile, think, mid 50s or something like that, right? Yeah.
Yeah, I think it's a great question. It's probably RSU as well, right? Restricted stock unit.
I didn't clarify that with him, but yeah, 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 right.
Versus like stock options, etc. So it really depends on the nitty-gritty to some detail, to some degree, because if it's a stock option it can expire, right? So then definitely exercise, sell enough to cover the taxes. And then to me it's hard because I don't like wearing like a financial advisor hat. Like I'm happy to give money coach type friend to friend advice, but I hate paying taxes. Like, you pay what you legally owe, but I don't like advising, people to sell their stock. It's not part of my strategy because I don't want to pay taxes, so I wouldn't advise other people to do things that would realize taxable events. Anything that I put in equities, I think is like for my children or for a very rainy day. I invest in real estate and I have cash flow strategies and I have, in certain situations, we build it out so that we can minimize taxes ideally as well. But that's kind of how I look at real estate, where I would kind of live off the cash flow, and I would look at a dividend stock where I would live off the dividend, but I wouldn't look to sell equity. I wouldn't look to sell real estate typically in a broad stroke type situation. Now, if he's in the late 50s, maybe he's thinking retirement, etc., then it changes things. And the other thing is also if he's in his 50s, at some point, it's important to talk about the risk profile, right? Like I'm big on Tesla, but will Tesla still see exponential growth every year? Debatable. On the flip side, when I started investing in Microsoft, it was like, oh, Microsoft is a mature company. Now, in the last 5, 7 years, Microsoft has seen massive growth, right? NVIDIA, another good example you mentioned, right? NVIDIA, whether it benefited from crypto or whatever it is, or AI and all of this like massive computing requirements today, I don't think 5 years ago people were saying, hey, NVIDIA is going to explode, you need to get in, right? So I think with your friend who's, in a tech company who's been doing well, it's hard, but sometimes when things are doing well, you need to take some money off the table. And it's a very it's like a kind of Warren Buffett kind of contrarian mentality where when the market is bad, you just tell yourself it's Black Friday, I'm going shopping, and you buy up your stocks. When the market is doing well, you kind of have to look at it and say, hey, let me rebalance the portfolio a little bit. And I say that while caveating that I don't like to sell. So I don't really take money off the table. I only buy when it's at a discount. But I'm also, at a different phase in life than, most of at 55, 50 would be thinking maybe differently. So I would say, focus on understanding your expenses, build out strategies to have the cash flow to pay for your expenses. And then, if you have kids, if you have grandkids, think about legacy planning and don't sell stock unless you need to, especially if it's a company that you think in 30 years will still be around.
I get that. Now, the for some of the folks from the West Coast, and we have a lot of folks on the West Coast who joined us. Now, in the East Coast, everyone knows you, etc. Right? That's great. They know your family. West Coast, you're relatively new to them. So when and I'm sure you get a lot of investors who come and there's some starting point, right? So how do those relationships mature, right? I mean, does it start with like, a million straight away, or, or maybe in one of those JM like funds, start with a smaller amount and build over time, or is it a mix of all of the above, right?
It's a mix, right? So I have like, people who have had $25 million exits and they're looking to deploy capital. I've had people who have, $3 to $5 million liquidity events that are looking to deploy capital. Typically, their starting points are a little higher. Then I have somebody who, you know, finds me or is referred to me, etc., and they're looking to build a relationship and it's more long term and they're thinking, hey, let me start and kind of build into this. And they can start at, 25K type investment. Typically, if they're using retirement funds like a self-directed IRA, they're typically starting at, around 100K. But fundamentally, from my perspective, it's not really about like how much they invest or anything. It's about building that relationship, right? It's about understanding, is this the right fit for them, right? Because if they're investing in a fund structure, real estate is an illiquid asset class. So the minimum investment period is 2 years. So I want to structure it and I want to kind of communicate that these are the reasons you shouldn't invest, because there are plenty of reasons why, people should invest. But fundamentally, I want to make sure that people are ready for that, 1 to 2 year period where in the first year they're making profit. About 97% of people reinvest, but at least, they kind of see that performance, but they're basically, more or less waiting a year to really see that performance. So it's important to really educate investors and make sure that they're aware of, how things are structured. And then, if they want references, more than happy to provide it. If they want to talk about past performance, more than happy to provide it. But also caveat that, past performance doesn't indicate, future success, because it's really important in our industry just to level set expectations and to kind of, communicate these disclaimers, because we don't want to communicate a sense that you're only ever going to make money. And in fact, in the Halal Money Show forum, that's haram, right? You can't have an investment that doesn't have risk, right? That's not Sharia compliant. So all investments carry risk, and it's important to be aware of that. And typically, most people are.
If there's any questions, just put it on the chat and I'll take that. This has been great. Now, I want to ask you this question, not because I want you to sell one or the other, but your
Ah,
perspective, right? Why do you like multifamily over, like retail malls or office or so many other asset classes within real estate? What's more compelling about multifamily? And again, this is not to for you to sell, the folks in
yeah.
multifamily, but I want to learn that for myself as well, right?
No, it's a great question. I think fundamentally it comes down to demand, right? Like when we talk about malls, maybe you haven't talked, but it's been written about how Amazon is basically destroying malls in terms of like the need to go to the mall, right? I personally hate going to the mall.
Yeah, I
Live
went to my
out.
neighborhood mall weeknight was just empty, man, dead empty, right?
So a couple years ago, I was at my uncle's house, and he was saying, "Oh, we're going to the mall," and I was scratching my head like, "Why?" And then I realized he was going to the mall to take his parents walking, right? So in the winter, it's cold in the Northeast, right?
Yeah, I get
Makes
that.
sense to go to the
Uh,
mall to walk, but in terms of like shopping, I feel like there's been a trend where it's, declined. Now, strip malls, on the other hand, there's still a lot of demand for strip malls. Office space has been decimated by COVID and this return to office type situation and leaving office, etc. But that's opportunistic. So what ends up happening, Tanvir, in my opinion, is like the real aggressive, savvy investor. If you're looking for different asset classes and you're looking to be diversified, I would choose three different asset classes, whether that's, multifamily real estate or office space or medical practice or whatever it is. And this is like advice that I see, family offices, people who are managing 100 million plus. This is the type of advice that they follow and that, helps them grow their portfolios. So that's where, my advice is coming from. Um, I would typically stick to three industries and I'd go very deep. I would, pick one that I'm working in and find the best partners in the other two. And that's how I would get my, portfolio diversification. And so that's what I would say at a high level. At a more nuanced level, why multifamily? I kind of touched on it in the beginning, right? We're in the midst of a housing crisis. There isn't that much ground up development going on nationwide. There's a lot in the Sun Belt. The Sun Belt, in my opinion, is overbuilt. I don't think we don't see the same demand that we do in the Northeast in terms of how quickly things get stabilized. So how quickly, units get rented out and how high occupancy is, meaning how many units of our portfolio is rented out. We see a lot of more strength in the Northeast, especially in New Jersey, New York area, which is why we invest there. So fundamentally, those are two big reasons. The third big reason that I touched on at a high level is the tax benefits in opportunity zones. It's very important to kind of understand, who are the different players and what are their objectives and goals. When the federal government, the state government, when they have a mandate or they have a goal, they're gonna make it so that it's easier for people who want to accomplish that same goal, accomplish that goal. And they do that through opportunity zones, if that makes sense. Basically, what they're saying is that this area we want to redevelop, but the government and the state are not in the business of development. So they're not going to do it themselves. They're going to make it more tax efficient for a developer to go in, buy land, and invest and develop. And then that developer will go in, improve the neighborhood. And then the people who live in that neighborhood will go from 1940s inventory to 2023 inventory, in our case at the same cost, right? Rent is the same. And that keeps demand sky high. That keeps occupancy sky high. That keeps our assets cash flowing. That enables our investors to make their return, hypothetically double-digit returns. So it's, everyone's in lockstep. Now, what happens over a 10-year period is now that area that was an opportunity zone is no longer an opportunity zone because the opportunity has been seized, right? People made money and they developed, and now inventory is no longer from the 1940s, it's now from 2020s, let's say. At that point, it's, oh man, we should have invested in this area 10 years ago. It's okay, you missed the boat. Inshallah, there will be another opportunity. And that's kind of the situation for us with multifamily. Fundamentally, people need to live somewhere. There's a lot of government vision, incentive, and rationale to developing these areas, and it's outside New York City. So these are the types of areas that 20 years from now, 30 years from now, you're still going to have LaGuardia, you're still going to have Newark, you're still going to have JFK creating, I believe, the busiest airspace in the world, right? So there's a lot of demand for that New York City metro area.
Got you. Here's a question from Brother Mo. I'll read it out to you and see if you can handle this, Mustafa.
Sure, hit
Why,
me.
why multifamily versus single? Now, he has a comment. A place like Kansas City, for instance, where rental demand is steady and vacancy rates are lower, most of the property there are single. He adds, are opportunity zones usually gentrified ghettos, right? And is that halalness questionable?
Okay, so a couple questions. So what,
Right.
what was that? Cincinnati, he said, or what was
He said Kansas City, right?
Kansas City? So yeah, Kansas City isn't a market I invest in, so I'll defer to people that are local to that market. And that's kind of the initial caveat that I mentioned about real estate.
And real estate is very localized, right? You need to
It
have
is.
local
It
knowledge,
is.
very local, right? Yeah.
It is, right? But that being said, Mo, I think invest where you think it's strategic, right? Like if you're seeing that you're in Kansas City, single family, from what I hear, is good in Kansas City. Fundamentally, it comes down to your ability to execute, right? Most often, this is what happens, Tanvir and everyone on the call and Mo. People start in single family because they don't have the money and experience. They go to duplex, triplex, quadplex, which is still, not commercial real estate technically. Then they go 5 units plus. Typically, what they're doing is value add. So typically, they're buying something that's in bad condition or less good condition, improving it and renting it out. So they're doing renovation. And then they graduate to a multifamily where they do the same strategy. That's typically what happens. Very rarely does somebody go from single family to single family ground up construction, or from single family to multifamily ground up construction. Most people in real estate don't do ground up construction. It's atypical, which is great for us. It's great value add. Now, I think the other section of the question, maybe Tanvir remind me, he talks about gentrification and whether it's halal or not. But was there another question before that?
Yeah, this is more relevant. Are opportunity zones usually gentrified ghettos, right?
So opportunity zones are usually in the process of being gentrified. And yeah, they are ghettos. So the way it works is fundamentally these are areas where historically people are not investing because they don't see the value in it. And that's why an area becomes a ghetto because businesses aren't coming in and spending money. People aren't necessarily staying there and spending money. So that area is not developing. So what the US did is they looked at nationwide and they said, hey, where are these areas where they're distressed or they're not necessarily good or they're ghettos, let's say. And how can we incentivize developers to come in and deploy capital to make these areas look nicer so that higher income people are looking to move there. Now these higher income earners are spending money locally. Now businesses will come and create businesses around these higher income earners to then spend money, and then that area no longer becomes a ghetto. So that's a process. It takes anywhere from 10 to 20 years. The area that we develop in when we entered the market about 13 years ago was a D class neighborhood. Now it's a C class neighborhood, C plus. We're in the process of building, B plus and A minus product in that market currently. In the next 10 years, it'll probably be a B class market. At that point, all of the opportunities will be seized, right? So it's one of those things that in New Jersey, to buy to buy at a tax, efficient manner, et cetera, where there's, low property tax, et cetera, is very difficult. So that's why, Mo, it comes down to like the opportunities in your market, right? If you're in Kansas in your city and you're seeing single family, go out, seize the market, buy everything you can. Just be aware that you're in that situation, you might be raising the cost of each unit if you're buying too much. Um, Now, what'll happen over time is you'll probably graduate to multifamily because the numbers will make more sense and you'll have more experience. Um, and then you may end up in ground up construction if the law is pro rezoning or if there's a lot of vacant land. It just depends on the market. Now, Tanvir, there was also a question about halal versus not halal, right?
Well, yeah, that's a little more complex. Yeah, the halalness like of gentrification, right? I don't
Yeah.
know how to address that. Yeah,
No, so
more threw a curveball at us. Yeah.
I love it. I love it, Mo, because gentrification is one of those things that just like real estate, it's a very broad term, right? It's very easy to look at gentrification negatively. Nothing I mentioned necessarily was negative, but what I would add is we hire locally, right? So if you're in a ghetto area and they don't have jobs, they're gonna potentially struggle to survive. And then they might be in a situation where they're forced, or anyone's forced, to do things that are not allowed legally, Islamically, etc. So I think it comes down to like our understanding of the fiqh and our intention and our niyat, and Allah knows best ultimately. But for us, we hire locally, right? We invest a lot in the local economy. And I've seen situations where it's positively impacted the neighborhood, where, crime rates are down, right? I have like a letter from the Mayor Patterson saying, thank you for all the good work you do. Um, there's different ways to improve neighborhoods where you're actually giving back to local community centers, etc. And you can only do that like if you understand the needs of the community rather than just us assuming that, hey, this is what the community needs. And so I think with gentrification, it's very easy to view it negatively. But fundamentally, if you're in the position where you're empowering people, you're hiring people, you're creating better standards of living for them, and I mentioned it with rent, right? Our rent is not more expensive. So it's a comparable price for a much better product which keeps demand high, which is good for us because we want our assets to be stabilized. We want somebody paying rent versus no one paying rent, right? So I think Mo, there's a couple layers with gentrification. From our perspective, it's not bad or haram, but more than happy to continue that conversation offline to kind of see your perspective.
Yeah,
Absolutely. Thank you.
I would love for Mo to reach out to you, Mustafa, and I'll share your information with him. Also,
Sure.
we'll start wrapping up. Shall I drop your email in the chat if people need to reach out to you?
Yeah, it's
Okay.
ml@velocecapital.com.
Actually, yeah, why don't we just do it on the fly? What's it again? I have to look it up.
I just messaged it to you. It's
Okay,
ml
great. I'll do that. Hey, we went a little bit over, but this was a great conversation. I really enjoyed this with you, Mustafa, and actually would love to see you come down to Silicon Valley in the future. If when we do, if you're able to do that, and we do like a in person or a hybrid event, it'll be nice to introduce you to many of the folks in my network and let them get to know you and Veloce Capital, inshallah.
Honestly, I would just come for to see your smile in real life.
And then you have a cousin in the Bay Area, so you have some additional incentive as well.
I
Yeah.
do.
Hey,
Well,
keep up the great work you're doing. Again, I'm not trying to over patronize you. Heard a lot of great things from my friends in JM. So keep up the good work. It's nice to see the next generation, taking the baton and building on what their parents did.
thank you. Thank you. You're
Yeah.
too kind. And thanks for inviting me. It was very nice to speak with you again, and we'll speak soon, inshallah.
And I'd love to see you come back again for we'll do one event called the Real Estate Summit, purely dedicated to real estate, so we can get into the details. I think this is good. I'll float this video to the community, and inshallah, we'll take it from there.
Beautiful, beautiful.
Okay.
Thanks again.
All right. Take care. All the best. Assalamu alaikum. The audience, you've been phenomenal. Thank you for everyone's participation and interactions. Stay tuned. I will send you a follow-up email. We'll do another session of the Halal Money Show, next quarter. And even if it's a hybrid event, many of you can still join remotely. And please continue supporting this, and hopefully we'll be able to connect, folks with, the companies like Veloci and many others. All right. So Jazakallah khair. You can reach out to me on LinkedIn. I'm, fairly reachable. And I've already posted my email. Great hangout with everybody. Have a great rest of your weekend. And yeah, be safe, everyone. Assalamu alaikum.